Money Show. Personal finance.
Well, a warning from SARS today that you should expect refunds to take longer as it tightens up on fraud and audit processes. It's been set a massive target by the Treasury in a zero-growth environment to grow the country's tax take. So what is your tax obligation? Warren Ingram, his job this evening is to help us look at when you should complete your tax returns, why you should complete your tax returns, even if you're not required to do so, and reduce the tax burden, because the tax burden on South Africans is massive, especially at the upper end. People, 103,000 people who earn more than 1.5 million rand a year are paying 45% of that. The rest of the middle class is paying a hefty chunk of their salary, a lot more than this time last year in taxes. You've got VAT on top of that. You've got the additional taxes of, private healthcare, private schools, private security, all of that sort of stuff. Effectively is a tax, Warren Ingram, in a country that can't afford to look after everybody.
And unfortunately, in a time when salaries are stagnating or often going down, So just to add to the whole depressing story, unfortunately that is the case. And I think in a time like that, as you said before we came on air, you have the obligation, I think, to build up your own savings and to build up your own capital, and to do that legitimately with as many legal ways to minimize your tax burden is only the intelligent thing to do. It's the right thing to do.
Before we talk about the hows of how you reduce your tax burden without getting yourself into trouble with those nice people from SARS, why should you complete a tax return even if you're not required to do so?
It wasn't really on my radar, and then one of my very sort of younger junior staff came to me and said, last year she didn't submit a tax return because if you earn less than 350,000 a year as a salary, and you only earn a salary. In other words, you don't get income from rent or something like that, and you don't get travel allowances, then SARS doesn't require you to submit a tax return.
You're still paying tax. Your company is still deducting PAYE, which your company should hand over to SARS on your behalf, but you don't have to go through the admin of logging onto e-filing or going and standing in a queue at a SARS branch and handing in documents.
Yeah, because your company's also completed an RP5, which is that's also gone through to SARS. So the SARS is completely informed. So this is an initiative by SARS to reduce the administration burden on the whole engine. So from that point of view, it makes sense. However, if you have a medical aid, and let's say, for example, you contribute to a retirement fund, then it might mean that actually you can get some tax back. The very refunds that you just mentioned that are going to take months and months to get back. Yep. And so if you don't complete a tax return, filling that information in, you're unable to get that refund.
So even if you're earning 350,000 Rand a year and you're contributing, say, even 20,000 Rand a year into retirement annuity, there is that tax benefit, of course, of doing that.
Yeah, and you get that changed slightly, but now it's a medical aid credit. So it's 286 Rand of medical aid credit. So if you contribute to a medical aid on a monthly basis, then you get a credit of 286 Rand a month that you can use, which again reduces the tax burden. And these are all legitimate.
When you say 286 Rand a month, is that really worth the admin? But actually, that's $1,500 a year.
It's money. Yep. It's money, and if you're a couple or you've got children, it just that really ratchets up very quickly. So to me, I think it's again, it's money that you could have in your pocket that you could be saving. So to me, it makes all the sense in the world. If you're in that situation, complete your tax returns.
Great advice.
And get it. And it's, so I must say these youngsters are awake out there.
Well, isn't that nice? At least the youngsters are awake. Legal ways of reducing your tax burden. How do you do it?
So, as we're talking about tax now, and so whatever's happened the last tax year, I'm afraid it's too late. Up until February was when you could reduce your tax. Now you've got this tax year and you've got a few months left to go. And I think a couple of things. One, we've just spoken about retirement funds. The law allows you to take 27.5% of your salary and contribute that to a retirement fund to get a tax deduction. And there is a limit, and that'll only apply to a few people, but a maximum of 350,000 a year. Now you get a major tax break on the contribution to savings for your own retirement. So to me, that's a really good decision to make, to contribute to your retirement fund. Remember, inside your retirement fund, it grows without paying any tax on its own. It doesn't pay dividends tax, income tax, capital gains tax, etc. So it's a very good way to grow. Make sure you're paying very low cost investments. Don't go and pay massive upfront fees, etc., because all the tax benefits get eroded from that. So to me, that's the first way. The second way, definitely the gift that keeps on giving, the tax-free savings, I hate calling them accounts, investments.
Yeah, I mean, it's a really dumb name for a really good product and a really good concept.
So you can contribute $2,750 a month to a tax-free savings investment, and it could be a unit trust, it could be exchange-traded funds, I think even shares nowadays with some of the providers, and a great way to build up. So and if some people are concerned about locking their money into a retirement fund. So if that is a concern of yours, they should have no concern with that, because you can, if you need to, pull the money out. You don't have a liquidity issue there. And then I think trying to find smart ways to reduce your taxable income from investments. And I think there are two that I've thought of. One, yes, you pay tax on dividends. It's a dividends withholdings tax, but very often much lower than the rate of income tax that you would pay if you earned rent or interest, as an example. So try, especially if you're younger, to try and have your investments biased to more into shares than into listed property and government bonds or cash, because your tax rate on dividends is much lower. And then try to buy investments and hold them. Don't try and trade them too frequently, because when the markets grow again one day and your investments start to grow again, then you start paying capital gains tax on top of that. And I'd rather be paying that infrequently than regularly. So to me, that's a nice way. And then the insurance salesman's best friend from 20 years ago, the good old endowment policy, has come in again. But it's come in a slightly different form, because nowadays endowment policies are actually very helpful for trusts and very high income tax paying people, because the tax that you pay on income tax within an endowment and the capital gains tax is much lower than what maximum income tax.
Explain to me, please, what is an endowment and why the tax structure is different. Sorry to put you under pressure at such short notice. Okay,
so an endowment, from a regulatory point of view, is considered to be a part of the life assurance industry. So it's a life policy, not on your life. It's a pure investment policy, but it has a particular set of regulations that control that.
So you commit to invest for a fixed period of time, or beyond a fixed period of time. You're not going to buy an investment in an endowment today and cash it in tomorrow.
No, the idea is that you need to plan to invest that money for a minimum of 5 years.
Yep.
If you go through that 5-year period, then the proceeds of that investment, so when you decide to sell it one day, you're not obliged after the 5-year period to sell it immediately. You can hold on to it, and if you decide in 20 or 30 years' time to make it an income-generating investment, you can do that. All of the money that gets paid to you will be tax-free. So that's the benefit of the endowment at the end.
It's a bit like a tax-free savings account, in other words, but this one just has a fixed, a minimum investment period tied to it.
Except inside the endowment, while your money is being invested, where a tax-free savings investment will attract no dividends tax, no income tax, no capital gains tax while it's going on inside, the endowment will have, but it will be at a tax rate of 30% from an income tax point of view, as opposed to the 45% if you really have a high income tax bracket. So that's where it comes. And the capital gains tax rates are also lower. And so that's where it doesn't really help someone who's at the lower end of the tax brackets in South Africa to contribute to an endowment, because their personal taxes are probably much lower. And so, when someone comes to you and says, buy an education policy, which is actually just an endowment, and you're only earning 10,000 Rand a month, it doesn't actually help you to do that. You should just go and buy a unit trust or an exchange traded fund. So endowment for trusts and for high income tax paying individuals, a great way to save tax, both inside the endowment while it's growing, and then after that 5-year period when you decide to access the money, then completely tax free for you forever.
Which is a really, really smart way of doing it, but you've got to be prepared to tie money up in a particular investment for a period of time. Yeah,
the nice thing is if you use the unit trust companies, they often give you those endowments for free. They just charge you for the cost of the unit trust itself. Then you can take about 95% of what you contributed out of the endowment without penalties or anything like that. You will be obliged to leave some behind for the full 5-year term. So to me, to get the tax benefit, obviously don't put it in if you know you're going to need the money in 3 years' time. That doesn't make sense. But if you put it in on the hope that you can leave it for 5 years, and then 3 years in something goes wrong and you do need to access the money, you can do that, and you'll need to take out 95% and leave a bit behind. But that would be a benefit to you. Just know then that 5-year rule doesn't necessarily apply then. In other words, you won't necessarily then get a tax-free amount in your hands if there has been good growth. But the shorter the period, obviously, the less growth there'll be.
Great guidance, Warren Ingram. Thank you very much. Warren Ingram is a financial advisor. He's a director at Galileo Capital. Share this with your friends. A podcast will be up as soon as the show is concluded this evening. And make sure that everybody in this tax season has a listen to this and take the various steps that Warren suggests, depending on your tax status, and consider them very, very seriously indeed, because it is about looking after yourself in your old age. And when you get to an age where you wanting to retire, whether that be at the traditional age of 60 or 65, or maybe you can push it out to 70. If you're lucky enough to work that long, you might own your own business and be able to do that. Most people in the corporate sector can't do that. But if you can delay the gratification of a retirement benefit until you're 70 years old, then you've got a much better chance of your money lasting you throughout your life, and maybe even having a little bit left over to give to the cat's home or whomever you choose after that. But the last thing you want to be doing is getting older and watching your savings deplete before you do. And that is desperate for far too many people, not only in South Africa, it's a global problem.